This is Daybreak Asia. We're counting down to Asia's major market opens. And actually, Haidi, it's a resumption of trade as well for Japan and Korea that have been shut for extended breaks. And what a market as well to be coming back into when you've just had US stocks notching their best three-day rally going back to November of last year.
We are really expecting that big jump, potentially to the tune of around 2% when it comes to Japan markets. We're also seeing some upside indicated for Australia as well. It is RBA decision day, widely expected to keep rates at that 12-year high of 4.35%, but watching out for perhaps some hawkish messaging as these market expectations build of higher for longer and maybe even more tightening back on the table.
Yeah, certainly something to be tracking later this morning. But here we've just got the open of Japanese equities coming online. And it really is that big earnings theme coming in across the course of this week. You've got earnings that are due from Toyota, Tokyo Electron. These are the biggest and also the fourth largest companies in terms of topics weighting. So they're likely to affect sentiment for the broader market. Going to definitely tell us how much investors, or companies rather, are benefiting as well from those twin narratives of the weak yen and also the AI-related boom. So we're going to be tracking those companies quite closely. You've got the Nikkei here coming online, 1% to the upside so far. Japanese yen, of course, have been tracking that trading. It has been fluctuating, but also really trading again a little bit to the weaker side this morning. You're moving back up to that 154 mark. We did hear from finance officials in Japan early this morning. Kanda, the vice finance minister, saying that they are prepared to take appropriate action if FX moves are too rapid. But again, we've been speaking with different investors, traders, who are saying 165 could be possible by the end of the year. That's the state of play there. Let's switch on, take a look at what's happening in Korea so far in the session as well, because you are seeing more moves here to the upside. You've got the Kospi up 1.6%, a little bit of strength as well coming back into the Korean won here this morning, reflecting, as we said, the moves that we've had in Wall Street over the past few sessions, better earnings coming through for the likes of big tech, but also adding to it, of course, Haidi, are those expectations around the Fed and following that softer than expected jobs report, the expectation that we could see perhaps Fed rate cuts by the end of the year.
And that's sort of a fairly similar picture when it comes to the RBA. As we know, that tight labour market is just one of the components of this broader economy that will be weighing on the RBA in terms of restraining its ability to kind of meet some of these previous market expectations of easing being the next step. So we're watching the RBA, of course. We're also sort of watching earnings as well, given that we had ANZ, the one to watch, announcing that 2 billion Aussie dollar buyback. First half earnings missed estimates, a trend of really the handing back to investors sweeteners as profits decline that we've seen across other major banks as well. A little bit of upside as we get into that staggered open here in Sydney. We're watching Australian bonds in terms of the short end, short-dated notes halting a three-day rally ahead of the RBA. We've seen Treasury bond futures taking a bit of a dip as well. There's a three-year note auction to be watching, as well as some remarks expected from the Minneapolis Fed President Neil Kashkari a little bit later on Tuesday. The Aussie dollar is holding pretty steady at that 66, I should say, 24 level. We have seen some moves when it comes to haven currencies, seeing that drop versus the peers as we see that equity rally advance. Watching oil and other commodities as well this morning. Crude is extending what is still a pretty modest advance. We're still seeing under $84 a barrel for Brent crude. These tensions in the Middle East, Israel rejecting that ceasefire proposal for the Gaza Strip. It is a broader risk-on mood for wider markets, but some upside support there for crude. And a final word, we're also watching some of these other metals as well. Iron ore prices are now up 20% and some from the low in early April. So watching iron ore and steel pricing and how that plays into some of the Australian miners as well. And as I mentioned, treasuries, this is a picture before we get some of those remarks from Neil Kashkari this morning, Belle.
Yeah, well, actually, let's stick with that Fed theme, bring in our next guest who expects Fed rate cuts twice this year and sees Asia outperforming in an easing cycle. With us is Ray Sharma-Ong, Head of Multi-Asset Investment Solutions for Southeast Asia at Aberdeen. And Ray, curious for your views here. Why exactly do you see that outperformance from Asia in particular, especially when we've already got the broader gauge around its highest levels of the year?
Yeah, that's right. So the reason why we see is because in Asia, you have higher growth and earnings potential compared to where you have in the US. Valuations in Asia are a lot cheaper. and currencies come with higher carry. So if you have a risk-on momentum in the US in a Fed easing cycle, we see Asia geared towards actually outperforming. Historical trend also shows when in a Fed easing cycle, Asia actually outperforms the US.
And are there any particular markets that you like?
Oh, yes, quite a few. So key markets we like are India, we like China, we like Korea and Taiwan. India, as we all know, is currently undergoing elections. We feel that there's a lot that's not in the price where elections are concerned. Election results are going to be released on the 4th of June. So should the Modi and the NDA majority be retained, it will be positive for markets. What's also important is that the new winning Indian government will be announcing a full budget in July. A lot of the budget announcements that they will likely roll out has not been in the price in terms of what they can do for capex, what they can do for earnings, what they can do for tax receipts, which we feel will be a significant boost to the markets outside of tax.
Ray, you're also more constructive on China now, and there's been quite a bit of interest given how low valuations have been. Do you see, though, with the return of some foreign flows over the last few sessions, is this a fundamental re-rating or just sort of coming off the bottom a bit?
So it's actually both. So we are positive on China, but cautiously optimistic. So we believe in being tactical around this. Reasons for the return in equity markets in China has been supported by a couple of drivers. First, we had better than expected macro numbers released out of China. We also had in Feb the rescue efforts by the Chinese authorities. We've also seen very strong earnings results, as well as broad-based renegotiations and re-engagements between the US as well as China. Now, for this to maintain, we feel that we need to see a few more things. Fundamentals in China has to pick up. So earnings in the first quarter needs to outperform. We think the base is quite low, so that is highly likely. The second would be policy execution. So China announced several measures targeting the improvement and regulation of the equity markets. If they execute that well, it will lead to a stronger equity market with a better blueprint for investor protection. And lastly, the intensity of US-China relations.
Ray, I was going to say, and at this point, H shares over A shares still?
Yes, definitely. So we do prefer offshore China H shares over onshore China A shares. H shares give you more exposure to tech and AI evolution. In addition, if you take a look at the chatter between China and the US, there have been re-engagements at the business level to talk about intergovernmental dialogue on AI. So we think momentum would be in that favor, and we do think this is where most of the offshore flows will likely head towards.
What about the direction for the Japanese currency? We've seen a bit of dollar softness of late with these changing expectations around the Fed, and perhaps that could ease a little bit of the pressure on the yen. But what's your outlook there?
Yeah, so the dollar is likely to soften. The Fed has already removed the probability of hikes in the near term. So it's just a question of when the Fed is to cut and by how much on the end. On the yen specifically, we have seen the Ministry of Finance Japan actually intervening when the yen approaches 160. So we actually do think the trading range would be between 150 to 165. So if it approaches 150, we do think it's a good tactical shot. It comes with high carry, 5% annualized on an annualized basis. But as it approaches 160, that's where you like to be a bit more cautious because the Ministry of Finance will likely step in. They want to dampen volatility. They want to dampen extreme moves in the currency at this present moment in time.
And with those moves in the Japanese yen, of course, playing into some of the gains that we've seen for Japanese equities, that weakness, do you see that persisting, or do you think that any sort of moves from here are going to be capped a little bit?
So the Japanese equity has more than just yen weakness going for it. It's undergoing a multi-generation, multi-year value unlock through its corporate reforms. We've seen strong corporate buyback, strong corporate governance reforms push. As an example, before the Japanese markets closed, a couple of companies actually announced buybacks for the first time in 9 years, and we see them pop double digits. So we expect more and more of these to come in. So corporate reform will come in, earnings will deliver, in addition to some gradual yen weakness, not so much as a key driver, but more on fundamentals and more corporate reforms being this. So it's a longer-term trade, which we think will do well for Japan.
Ray, always great to have you with us. Ray Sharma-Ong, Head of Multi-Asset Investment Solutions for Southeast Asia at Aberdeen. Still ahead on Daybreak, Chinese President Xi Jinping continues his European visit. We'll be telling you what topped the agenda during his meeting with French President Emmanuel Macron next. This is Bloomberg.
Chinese President Xi Jinping has held talks with his French counterpart, calling on Emmanuel Macron to help fend off what he calls a new Cold War. For more, let's bring in our Asia government and economy correspondent Rebecca Chung-Wilkins joining us. And Rebecca, when you've got the EU as a bloc increasingly aligning with the US and this risk of security and trade tensions as well, how likely is France going to be to heed that message?
Well, I think this is sort of at the heart of the object, really, of Xi Jinping's visit. What he essentially wants is France, which is a leading power of the EU, to put a lot more space between the EU position and the US position, particularly when it comes to this litany of probes that we've seen into not just EVs, but other areas of green tech. Now, Macron has shown himself historically to be relatively open to at least a more independent position from the US. Historically has seen the EU as a way of sort of charting a middle path for countries like China and not necessarily wanting always to sort of move lock in step, particularly when it comes to these sort of policies. So I think in that sense, Xi Jinping certainly has some kind of optimism, or certainly hopeful, that Macron will be able to be understanding of his position, that he is at least a partner that he can sit down and have this sort of robust conversation with.
Rebecca, when it comes to sort of tangible outcomes, obviously the elephant in the room when it comes to this visit and this region were the issues of overcapacity, not to mention the escalating security and diplomatic tensions. Did that become apparent in any of these conversations?
Well, we sort of saw little glimmers of it here and there. I mean, when we had the sit-down, the trilat between Ursula von der Leyen and Emmanuel Macron and Xi Jinping, the readout from Chinese state media was relatively positive, but it did point at some of the strains in the relationship. Xi Jinping very clearly saying, for example, that there's no such thing as China's overcapacity problem, and also China sort of reiterating its position that the EU, from its point of view, is this long-term strategic partner, a major partner, as well as this sort of hint that the relationship doesn't target any third party, nor should it be dependent or dictated by any third party. A little dig there, perhaps, or an oblique reference to the US, perhaps an implication that the EU might be being sort of pushed around or moved by the US.
Our Asia government and economy correspondent Rebecca Chung-Wilkins there with the latest. And some of the top corporate headlines that we're tracking this hour. Citigroup has shifted the work hours of some of its staff in Kuala Lumpur to align with those in the US. The move is part of efforts to ensure a smooth transition to a one-day settlement cycle. Citi has also created a task force that will solely focus on the process known as T+1. It joins dozens of other financial institutions preparing for the shift that comes into effect on May 28th. Nomura is targeting 20% revenue gains for its global markets unit over the next few years. The unit's head told Bloomberg they expect 25 to 30% growth in macro, credit products and in equities, with the rest coming from wealth management. The business has returned to profit after 3 years of losses that included a $3 billion hit for the Miyakegos scandal. Take a look at how we're travelling when it comes to trading in ANZ. The lender seeing a bit of downside of over 1.5%, announcing a $2 billion Australian dollar buyback after first half earnings missed estimates. Group CEO Shane Elliott told us where they're seeing pockets of strength in their businesses.
We came off a record 2023, and what really delivered here, you know, revenue was flat at a really, really strong level. Expenses well managed, and importantly, it really shone through, I think, the value of having a diversified portfolio. As you know, the Australian retail and small business banking market has been subdued, and we experienced that like our peers, but we had really strong offsetting performance in our institutional and international business. So I actually saw a lot of strength in the result, and I think we're very well positioned for the environment.
You're joining us on RBA Day, of course. After 4.25 points of hikes, how are you kind of seeing the mood when it comes to clients, customers, and the broader economy, and how that's impacting your business?
Yeah, sure. So clearly there is some stress on the economy. I mean, that's to be expected given the interest rate rises, cost of living pressures, etc. So the market is subdued, particularly here, in Australia and New Zealand. And we see that. And we see that with more customers struggling, although the number of customers struggling is still, from a historic point of view, relatively low. So we have these hardship programs like all the banks. So people who are finding it tough call up the bank and ask for hardship. The number of people in our hardship program is 0.3% of all our customers. Now, it's devastating for those 0.3%, but it's 0.3%. 79% of our customers in home loans are still ahead on their repayment, so have paid more than they are required to do, and 50% are ahead by more than 3 months. So there's a remarkable resilience still sitting in the economy, although things are subdued.
With competition pretty fierce within Australia, how vindicated are you by your international strategy? And I'm wondering if you can give us an update, given there were discussions with pension funds to bring into India, investment in the special economic zone, and also maybe an update on how procurement of licences is going in the Chinese market for ANZ.
Yeah, great. So, look, the point of difference for ANZ is we're the most diversified of the major banks in Australia. We have 4 great businesses: New Zealand, our retail business here in Australia, our small business banking here in Australia, and, of course, institutional. And probably the piece that we really shine in terms of our point of difference is institutional, which services some of the world's best companies, biggest companies around the region of Asia Pacific. And we operate in 29 markets around the world. And that business really came through very strongly. So now it's been hard work. You can't just turn up in Singapore or India or China and expect to get a fair go. You've got to work really hard. And we've worked really hard building a strong foundation with the right customers, knowing and investing in things that we think we do better than others, which is facilitating the movement of goods and capital around the region. So we're in all the right places we need to be. We've got all the licenses we need to have. And more importantly, we have the customers that we need.
That was the ANZ Group CEO Shane Elliott speaking to us just a short time ago, and you can get a roundup of all the stories you need to get your day going in today's edition of Daybreak. Bloomberg subscribers go to Daybreak on their terminals. It's also available on mobile in the Bloomberg Anywhere app. You can customize your settings so you only get news on the industries and the assets that you care about. This is Bloomberg.
Israel is rejecting a ceasefire plan backed by Hamas, saying it falls short and that its operations in Rafah will continue. Let's get the latest from our editor, Michael Heath. So was it a surprise that this did not come through?
It was a bit, Heidi. I mean, there was such a push on from the US, from the Middle East, and from the Gulf countries, Middle East, Egypt particularly as well, to try and get this done and to try and get those hostages out and try and get some relief into the civilians in Gaza. So there was a lot of work put into it, a lot of pressure put on. Obviously, the firing of a rocket by Hamas from the Rafah area into an Israeli checkpoint that killed 4 soldiers did not help the situation. Israel has since begun warning people in Rafah that they need to move because an operation will begin. So in that, the difficulty here at the end of the day is that neither of the warring sides appear to have to see it as in their interest to stop fighting right now. And there's a bit of a game of bluff going on at the moment, is that I think Hamas expects that Israel, the US in particular, and global opinion will push Israel into a ceasefire if they can just keep holding out. Benjamin Netanyahu, the Prime Minister of Israel, is sort of the view that he's got to complete this operation and destroy Hamas to do what he said would be done and to give himself a chance of forming another government. So in a sense, there are a lot of forces working against it. Now, Israel has said it's still going to go on to the negotiations to try to exhaust them, but it looks to all intents and purposes that it's not going to happen, unfortunately.
So what do you think then, if an invasion of Rafah sort of seems inevitable at this point in time, how extensive could we expect it to be, or is it really just too early to say at this stage?
A bit too early to say at this stage, Annabelle. I mean, they're not talking about moving people out of the whole area. I mean, there's 1.4 million, an estimated 1.4 million people there. This affects about 100,000 people, and the off-the-record Israeli officials are saying that to actually move a large number of people out of Rafah would take a few weeks. So the operation is imminent. There's been airstrikes that have taken place. It looks like they're targeting areas at the moment. So we just can't tell how extensive it will be, but Israel's been pretty steadfast. Even the opposition has backed this, that they must go into Rafah. There's an estimated 5,000 to 8,000 Hamas militants there. The job must be done, considering what happened on October the 7th. They can't leave Hamas in charge and leave the door open to something like that happening again.
The question was where these people were going to go, right? And that remains a question, particularly if you're talking about the entire population of that area. We know that UNICEF has said there's more than 600,000 children that are part of the population. President Biden has said this is a red line. Is there a sense that Israel is taking that seriously?
Look, they do have to say, it's real smoke and mirrors, isn't it? I mean, they do have to take what Biden's saying seriously. Could he actually cut off weapons sales or anything like that, or aid to Israel? It's very difficult to say. I mean, Israel is sort of doing what the US had wanted, which is to start moving people out. But where do they go? I mean, some of the reporting we've had on the ground is that people aren't responding to the Israeli warning, because where will they go? I mean, the rest of the strip has basically been destroyed. Now, Israel says it's setting up tents around Khan Yunis, which is a city a bit further north. But there's just so many people, there's so much destruction. It's very, very difficult to see how you can move that many people out and clear the area to just have a straight fight between Hamas and Israel. And it's in Hamas's interest to keep as many people around there as possible.
Operationally, this feels like we're getting into a point where the end might be sort of in sight. I don't know if it's fair to say that. Is there conversation about what Gaza looks like after this?
It's a real problem, Heidi. I mean, this is exactly what the US and the Gulf states and other interested parties want. They want a plan for afterwards, and Israel's been specific in avoiding exactly that. I mean, there's big issues at stake. The US and Saudi Arabia have basically got to the point where they're prepared to have a deal whereby the US would become a strategic ally of Saudi Arabia to protect it from Iran. Saudi Arabia in turn would recognise Israel, which would enhance Israel's security. But the caveat is Israel has to begin this process towards a Palestinian state. Now, this is the most right-wing government in Israeli history. The idea that this group of all people would allow that to happen. I mean, some of the members of the cabinet, they're talking about sending Israeli settlers into Gaza. They're not talking about statehood. So there's huge stakes here. But whether it can actually be pulled off, I mean, it's very hard to be optimistic given what we've seen in recent weeks.
That was our Bloomberg editor, Michael Heath there. Thanks so much for your insights. And let's head now to the Milken conference. It's closing out the first day here. We've actually got Elon Musk, who's being interviewed right now by Michael Milken, as we said, closing out the first full day of the conference, currently speaking about exploring and colonising other planets. Take a listen.
Civilization is precarious and rare, and that you should really think of human civilization as being like a tiny candle in a vast darkness, and we should do everything possible to ensure that that candle does not go out.
So, Elon, I thought one of the interesting things for the people on X viewing this session and the people in the audience here is that maybe I'd give you a few of your quotes and you can comment on them. Okay, let's start with this one. Free speech. Freedom of speech is the bedrock of democracy. Without it, America ends.
Taking a look at how markets are tracking this morning, we've got Japan and Korea coming back from extended breaks here, and taking a look at the Nikkei in particular because we've just had some data points dropping. This is the final reading for April from the Jibun Bank Japan PMI Composite and Services. Both of those holding fairly steady from the prior readings, and importantly as well, holding above that key 50 mark. So 52.3 for the composite reading and 54.3 for services as well. What else we're tracking today is just that general optimism that's coming into the session so far. A bit of a catch up as well, given we saw US equities seeing their best three-day rally since November overnight. The 50-day moving average threshold also crossed by the S&P 500. So it is a little bit down to the earnings theme, of course. We've seen pretty solid numbers from a lot of the big tech space, but also, Heidi, as always, those expectations around the Fed and these predictions that we could see perhaps a Fed rate cut as soon as September, of course, really playing into that. But you're, of course, very closely trained on what the RBA is doing today as well.
Yeah, and this kind of a narrative that keeps shifting, right? Higher for longer, but when does the first cut come through? Bloomberg Economics doesn't expect that to happen until well into the second half. And a lot of economists are saying not at all this year. But the RBA for today, at least, expected to keep settings unchanged with the policy decision later on Tuesday. They'll also be releasing their updated economic forecasts. Our economic reporter, Swati Pandey, joins us now for more. So the forecasts will be interesting. The level of hawkishness in the communications will be interesting too.
Yes, so in the February statement, we had seen they used the word further interest rate increases cannot be ruled out. In March, they dropped that to make it we are not ruling anything in or out. So they kind of watered that down, and it was seen as a dovish line. Whether they bring back further increases cannot be ruled out in today's statement, or whether they keep it as it is will be something that the markets will be closely watching out for. And also important to note that in the February economic outlook, expectations from markets and economists both were for interest rate cuts for later this year. Now there is expectation that there could be a hike.
We've seen really globally rate cut bets being pushed back. So in terms of market pricing, is there a sense that we're seeing a similar level of pullback in terms of expectations that we've seen with the Fed?
Yes, so we had our inflation report last week, and that was pretty strong, higher than expected. It is 3.6%. Markets were expecting 3.5%. So it wasn't huge, but the fact that we are not seeing that disinflation trend continue, and something that happened overseas as well took markets off guard, and we saw market pricing for rate cuts go away, but we are also seeing roughly 35 to 40% probability of another interest rate increase by August.
Outside of inflation, Swati, what else are we hearing on the economic front, or what are the other data points telling us?
Look, the labor market is pretty strong. Unemployment is still low, and it's expected to remain low. We have some forward indicators on the labor market which are still pointing to strong demand. And another interesting thing is, housing market continues to be strong. We had auto sales data for March, which was a record for the month of March. So if we kind of look outside of retail sales data, which is weak, it looks like the economic momentum is going on, and that is some solace for the Reserve Bank, which wants to ensure that the economy is in soft landing and that they are able to preserve labor market gains. So even with strong inflation, if they do need to raise interest rate, the economy can probably stomach that.
That was our economics reporter, Swati Pandey there. And the State Street CEO, Ron O'Hanley, says capital markets have shown strong resilience in weathering serious challenges in recent years, from wars to the pandemic. O'Hanley spoke to us at the Milken Institute Global Conference in Beverly Hills.
Before talking about the future, let's just talk about the recent past. I mean, if you think about what the world has been through in terms of the challenges it's faced, and any kind of challenge in the real economy translates to the financial economy. So we've had a pandemic, a once-in-a-century kind of pandemic, and we've also had ground war break out in Europe. And if you think about how capital markets have actually adapted to that, how you've seen underlying economies repair themselves. And again, the capital markets are very much a function of what goes on in the real economy. And you've seen, I think, extraordinary resilience in the real economy relative to what any of us would have expected.
What do you think was behind that resilience?
Not to sound jingoistic, but I think a lot of it was the U.S. led the way in terms of certainly in the repair of supply chains. I mean, what we were talking about in the middle of 2020 was the potential for this going on for 4, 5, 6 years. And the rebalancing would take that long. And in fact, really led by U.S. corporations, but also just large corporations around the world. It was really led by large companies figuring this out and saying, what do we need to do here?
It's interesting that you bring that up, Ron, because if you think about the pandemic, global companies are rethinking their supply chains, and that has led to a new kind of investable idea. Walk us through kind of the new investable ideas coming off of the pandemic and just a lot of things being different.
Well, let's just stick with supply chains for a moment. I think that maybe with globalization we went a little bit too far because supply chains became highly, highly optimized with very little built-in, if you will, slack, or for that matter, capacity for the unexpected. So what you're seeing now is really a much more resiliency being built in supply chains. Instead of having single source, it might be double source, triple source. You're seeing some activities being brought back to countries, reshoring. And it's not so much those aren't political statements as much as they are, you know what, we really ought to have a little capacity in whatever country, here in the US, here in Germany, here in the UK. And then finally, you're seeing opportunities being created for other countries.
Right.
Where it may be that a country like China had it all, or had a large portion of it, and China's not going to lose everything, but you're starting to see other countries in Southeast Asia. All of these represent investment ideas.
We're seeing a lot of more things shifted to like South America, Latin America. One thing I want to ask you, we were all focused this weekend over the annual meeting out at Berkshire Hathaway and Warren Buffett. Warren saying Wall Street creating kind of a casino-like atmosphere. He's talked about this before for investors. Do you agree with that assessment, or how do you see it?
So I think there's a concern about market valuations, and it's really a concern about a relatively small number of companies that are seeing lots of valuation expansion driven by things like AI and the belief of AI. So a couple things I'd say about that. If you take the S&P 500 index, right, which is cap weighted, and just equal weighted, you actually say it's actually not that overvalued. And by the way, there's opportunities in lots of other companies, right? You were talking about 7 companies in the S&P 500. So that would be point number one. Point number two, which I do think we do need to think about, I'm old enough to remember the advent of the internet. And if you think about the mid to the late...
Not that old, actually.
If you think about the mid to the late 90s, there was that same kind of excitement, same kind of exuberance around a few companies. The internet was going to change everything, and it was going to change everything right away. And then 1999 and 2000 came. And we could find ourselves in a situation like that again, because the hype of a technology oftentimes isn't met by the actual implementation of it. So if you ask me what do I believe, I think that artificial intelligence in all of its forms will be a fundamental game changer for many industries. Is it going to happen overnight, and is it going to kind of reflect the valuations that you're seeing in a few companies? Probably not.
State Street CEO Rono Hanley there, speaking with our colleagues Carol Mercer and Romaine Bostich. Take a look at some of the stocks that we're watching in the Japan and Sydney sessions. Some of those other earnings really dominating. ANZ is obviously one that we're watching in Sydney. We're actually coming off those session lows there. We did see declines of as much as 2.7%, the most since the middle of April. First half cash profit missed analyst expectations, but returning money to shareholders with that share buyback, really in line with the trend that we're seeing across other lenders there as well. Some analysis looking at that core profit loss likely due to a higher than expected cost scenario. Also watching some earnings out of Japan. Fast retailing is one of them. We are seeing potentially when it comes to expectations, earnings out a little bit later on this week. We did have April sales up by almost 19%, and there are some pretty high expectations that the Chinese recovery could actually fuel the overseas sales segment and profit growth for fast retailing after what has been a challenging few quarters there. So international focus will be, markets I should say, will be the key focus there. Also watching Nintendo, we're up by 3% in the session there. Sales and operating profit, though, expected to have slumped by 10% or more in that first 3 months of the year. Nintendo continuing to rely on the Switch console platform, which, as we know, is aging. So when we get to those numbers, a lot of the attention will also be focused on the roadmap to a successor to the Switch console. We do have more to come here on Daybreak Asia. This is Bloomberg.
Taking you to some live pictures here at the Milken Institute, Beverly Hills, that conference closing out the first day. And you can see here Elon Musk. He is being interviewed right now by Michael Milken. The two have been talking about exploring and colonizing other planets. He's also spoken, Elon Musk, about the outlook for regulation in California in particular. But let's listen in.
Yeah. There's not an inevitable upward trajectory. A lot of civilizations have risen and fallen in recent years.
Yes. I suspect most people in this room have actually read history, but if you haven't, I just strongly recommend it. It sounds obvious, but you know, there's been so many civilizations that have risen and fallen, many that we just don't have much of a record of. You know, like I mentioned, the ancient Sumerians, like their language was forgotten for a long time until it was finally decoded only in the last, I don't know, 200-300 years, but like it's around 1800 and something, or in the 1800s, I think. But it's been very recent, like, so for several thousand years, nobody understood what those tablets meant. Because they're the ruins of a long-dead civilization. And there are many long-dead civilizations. At some point, our civilization will come to an end, too. We just don't want it to be anytime soon.
Elon Musk, as you can see there, speaking on stage at the Milken Institute conference in Beverly Hills. What hasn't come up in that conversation so far is the outlook for Tesla and Tesla's operations in China in particular. That's something we already got some insights on from our guests at the BNP Paribas EV conference in Hong Kong. Take a listen.
But Tesla really needs China. Obviously, it's the biggest car market in the world. They want to lead on full self-driving globally, and they weren't doing that in China. So this at least helps them close that gap to the peers, which was starting to open. But they still have a lot of work to do to really become a leader on that.
Is Tesla in trouble in China?
I wouldn't say Tesla's in trouble in China at all. They were still selling a huge amount of cars here.
The market's growing quite fast. The UV segment grew 27% last year, so it's natural that people want to come in. And for us, competition is welcome. We have confidence in the portfolio that we have at this point in time. We actually think global competitors coming in should bring in a lot of credibility for the segment. Like I said, it's early days in the EV segment, so it should get excitement and credibility to the segment, and that I'm hoping will help us grow the categories.
Let's bring in Tu Li. He's managing director at the US-based consultancy Sino Auto Insights. And Tu, I'm interested for your views here because we know Tesla's been under immense strain or pressure in China, weaker sales, price war for EVs. We did see a little bit of upside coming back in after we had this indication that it would receive in principle approval for its full self-driving program in the country. How much do you really see that helping Tesla along?
I think it gets them into the game. Currently, they're not in the game. Companies like NIO, XPeng, Li Auto, Huawei has several brands that they've partnered with that have intelligent driving systems. So it's a fairly mature and competitive market in the ADAS systems, what full self-driving is. So with Tesla being allowed to offer that to the Chinese consumer, I think it makes their vehicles more attractive, but we're still talking about a 3- and 4-year-old EV, where in a market where refreshes happen every 6-12 months.
Yeah, and that really does seem to point to perhaps Tesla's biggest problem in China is this perception perhaps that it has sort of an aging look or an aging lineup. What do you think could sort of shift that? I mean, they are bringing out new models and they're going all in on their robo-taxi, for instance. Do you see any of that helping them there in particular?
I see it helping incrementally, but at the end of the day, there's two things that China offers that the rest of the world doesn't. It's a production base. 50% of their production came out of China last year. About 600,000 units were sold in China. And then it's the largest market in the world, so it creates the most growth opportunity. But with an aging lineup and vehicles that are well over $25,000 US in China, it doesn't bode well. Instantly, you could create some credibility with a Model 2 that's around $25,000. But even then, it's not an instant hit because BYD lives in that segment. And there are a number of brands, due to the price war, that have come down. And so on a Model 2 that launches within the next 12, 18 months, the feature set would have to be pretty substantial, including a competitively priced full self-driving feature in order to really gain any significant share.
What does it tell you about the dedication to this market, right? We know that his recent visit came at the expense of a scheduled visit to India, obviously another key burgeoning market. Do you think doubling down in terms of just his presence and his personal investment in China is going to have an impact?
I think it's going to have the biggest impact. You know, the United States and European Union are slowing down with EV growth. It's still growing, but it's flattening out a little bit. Hybrids have become a major player that are taking sales away from pure battery electric vehicles. And again, the China market should hit around 10 million units of NEVs, including hybrids and BEVs this year. So the China market for Tesla gives them the most bang for their buck, but it's also going to be the toughest nut to crack because of the speed at which competition happens, innovation happens, and the downward pressure from the price wars.
Given the cost pressures, given the renewed dedication to China, do you think the expansion of the Shanghai plant is kind of a done deal for the new budget model?
I think they're going to have to be very, very careful with that because as they continue to build capacity, they have Berlin Giga now, and they're looking at India, and they already have Austin. So they have to be careful about expanding capacity because that capacity needs to be sold either domestically or it needs to be exported. And so at 1.3 million units of current capacity at Shanghai Giga, they probably just need to focus on that first, see how well the Model 2 plays out, and then maybe look at long-term expanding, doubling capacity because Tesla is going to use China as a manufacturing hub, just like every other automaker, Volkswagen, GM. And so long-term, they're going to be here. They're going to need to expand capacity. But in the short term, they need to be very careful with how they invest that capital.
What about for the Chinese EV makers? Because we know overcapacity has been a key tension or friction point between China and the EU in particular. And we've got President Xi Jinping as well on a three-nation trip of Europe right now underway. But those overcapacity concerns that have been flagged by the bloc, how much do you think that that's going to really impact Chinese automakers in turn?
The overcapacity is primarily currently on the ICE side or the petrol engine side. You see Russia taking a lot of Chinese exports, Latin America, but mostly on the petrol side. We're seeing the EV growth into exports pretty extreme, but I wouldn't say there's a ton of overcapacity in the EV space. What's really putting pressure on the EV makers to export is the price war. The price war is not so they're missing out on sales in China because there's so many competitors, and so that creates pressure. It's not due to overcapacity; it's because they're not able to sell the current capacity they have in the China market, so they're being forced to move it abroad. And so I think kind of creating that nuance makes a difference when you have these types of conversations about overcapacity.
Julie, really great to have you with us, Managing Director at Sino Auto Insights. You can also turn to your Bloomberg for more on Elon Musk, who is speaking at the Milken Institute Global Conference. Terminal users can watch that at LiveGo. You can head to TLIV Go to get commentary and analysis from our expert editors.
All right, taking a look at the moves that we've seen in Hong Kong stocks on a tear. You're now looking at overbought territory, perhaps, but the biggest winning streak since 2018. Let's get more on that now, bring in our Bloomberg opinion columnist, Shuli Ren. And Shuli, two fears perhaps are driving this rally.
Absolutely. The fear of being caught and the fear of missing out. The fear of being caught in the sense that global investors were too heavily overweight on Japanese stocks and the semiconductor stocks, which is basically TSMC and the Samsung Electronics. And as the earnings season unfolds, they realize, oops, TSMC is cutting its growth outlook, and the Japanese yen is so volatile, it slid all the way into 160. That means that the dollar-based investors are really not making as much money as domestic investors. On the other hand, the Chinese latest Politburo meeting, the latest readout that came out on April 30th, showed that the Chinese government seems open to taking a different approach to solve its economic problems, that the policy paralysis is over. And we all know Chinese shares are very, very, very cheap.
Yeah, so what is it? China suddenly looks more attractive or other places look less attractive?
Absolutely. So the places that used to be very attractive, people are afraid of being caught because they bought really high. And then China, you know, like the rally could be pretty big because it's just so cheap.
Okay, well, surely, of course, so we're tracking those Hong Kong moves very closely. And as we said, longest winning streak going back to 2018. We'll have more ahead with the opens in Hong Kong, Shenzhen and Shanghai. That was our Bloomberg opinion columnist there, Shuli Ren. More ahead. This is Bloomberg.